Westwood, welcome to the Financial Five for November 2025, where I cover timely and relevant financial topics in about 5 minutes. My name is Tom Mullen, and I'm a certified financial planner and college funding and student loan advisor. With the end of the year approaching, it is a great time to talk about Roth IRAs. As a financial planner, I get calls from clients, family, friends, hoping to clarify what has a December 31st deadline and what has a tax day deadline. We're going to take the next 5 minutes or so to talk about important deadlines that pertain to Roth IRAs and also what opportunities exist with Roths that might help you accomplish your long-term financial goals. Today's topic will focus on three things: Roth contributions, backdoor Roths, and Roth conversions. First, let's go into some Roth basics. What are they and how do they work? A Roth IRA is an individual retirement savings account where you contribute money that has already been taxed, and in return, your investments grow tax-free. Distributions are also tax and penalty-free when taken after age 59 and a half. Tax-free growth and withdrawals are very beneficial to a retirement plan. Withdrawals from a Roth can help retirees manage their tax bracket in retirement when many other sources of retirement like traditional IRAs or 401ks are taxed as regular income. Roth IRAs are also one of the best assets to inherit. Beneficiaries have up to 10 years to withdraw assets after the passing of the original owner, and again, no taxes are owed. Let's dive into contributions. For 2025, the maximum Roth IRA contribution is $7,000 with an additional $1,000 catch-up contribution for those aged 50 and older. For 2026, these limits are projected to be $7,500 and $8,600, including the catch-up. Contributions can be withdrawn at any time, but the growth on your investments have to stay in the Roth for at least 5 years before you can withdraw tax and penalty-free. If a single tax filer has less than $150,000 in earned income, they can contribute the full amount based on their age. If a single tax filer makes over $165,000, they are ineligible to make a contribution. If they're in between $150,000 and $165,000, they may be eligible to make a partial contribution. If you're somewhere in that range, there are calculators and CPAs that can help you figure it out. Contributions for 2025 can be made all the way until tax filing day, around April 15th, 2026. Next, I'll talk about backdoor Roth contributions. If you're looking at this chart and realize that you make too much money to contribute to a Roth, don't fret. There might be a way for you still to participate. There's a loophole that allows high-income earners to boost their Roth savings. There are a few steps to follow and a couple of things to consider. Step one, you open up both a traditional and a Roth IRA. To make your life easy, you should open up at the same financial institution. Step two, contribute to the traditional IRA. So you make a non-deductible after-tax contribution up to the annual limit. Again, for 2025, this is $7,000 or $8,000 for those aged 50 or older. Step three, convert the funds to a Roth IRA as soon as the funds settle to minimize any potential taxable gains. Transfer them to the Roth IRA via a conversion. Now, to address the considerations. First is something called the pro rata rule. This is the most complex part. If you have any existing pre-tax money in any traditional SEP or simple IRAs, the IRS requires the conversion to be done proportionally from all your non-Roth IRA balances. A portion of the conversion will be considered pre-tax and thus taxable. You want to be absolutely sure about whether this would apply to any of your savings, so there are no tax surprises. The strategy works best if you have a zero balance in any other IRA on December 31st of the conversion year. Taxes on earnings. If any investment earnings accrue in the traditional IRA between the time of contribution and conversion, those earnings are considered pre-tax and will be subject to income tax at the time of conversion. This is why the conversion is typically done immediately. Our third and final topic for today I will cover is Roth conversions. A Roth conversion involves moving pre-tax funds from accounts like a traditional IRA to a Roth. The converted amount is added to your taxable income in the year of the conversion, but future earnings and qualified withdrawals will be tax-free. The ideal time to convert is often during a lower income year to minimize the upfront tax bill. Timing really matters. One of the best windows for Roth conversions is after you retire, but before you have to take your required minimum distribution from your pre-tax savings at age 73. Things like pensions, deferred compensation, or other significant financial events can easily change this math, which is why it is always smart to loop in a professional. Some benefits of a Roth IRA conversion: tax-free retirement withdrawals. Because you pay the taxes upfront on the converted amount, all the qualified withdrawals of contributions and earnings in retirement are tax-free. Required minimum distributions. The IRS does not require you to take an RMD from a Roth, allowing the money to grow tax-free for longer. As you convert from a pre-tax IRA, it also will lower what is required to be withdrawn starting at age 73. Tax diversification. Having a mix of tax-deferred and tax-free accounts gives you more control over your income and tax bracket in retirement. Hedge against future tax hikes. If you expect to be in a higher tax bracket in the future, paying taxes now at a lower rate can be beneficial. Drawbacks of a Roth conversion: immediate tax bill. You must pay taxes on the converted amount, which could be substantial and might push you into a higher tax bracket for the conversion year. Loss of assets. Ideally, taxes should be paid with the funds from outside the retirement account. Using converted funds to pay the tax reduces the amount you have invested for tax-free growth and may trigger a 10% penalty if you're under 59.5. Irreversible decision. Since 2018, Roth conversions are irrevocable and cannot be undone. Potential for higher Medicare premiums. A larger conversion can increase your modified adjusted gross income, which could result in higher Medicare Part B and Part D premiums. In summary, Roth IRAs with proper planning can be a powerful tool for retirement. There are multiple ways for you to get money into a Roth so that it can grow tax-free for your retirement, or as a way to fund your legacy goals. It is important to loop in professionals like a CFP and CPA that can help you make great decisions every step of the way. Now, on to my final thought. The College of Financial Planning says that every person should have 3 to 6 months of their expenses in cash as an emergency fund. What I would add to that is you should hold it in a money market with a competitive yield and high liquidity. Thank you.